So obviously we'll get into elections in in a little bit, but on that note, everybody, depending on what side you're on, you're seeing a lot of political ads right now, and one side the economy is absolutely terrible. It's the worst possible economy we've ever been in, and then the other side, it's the greatest economy. Look how great everything's going. Where would you say we're at economy wise? How strong is the economy right now?
That's a pretty good economy. Hopefully, that's not a political statement. It's a pretty good economy. It's an economy that has a fairly low unemployment rate. Jobless claims remain pretty well contained week to week. The consumer, still spending. It's not going to be as good of an economy as we saw through 23 and some of this year. I mean, things slow. That's the idea of it. I mean, remember, consumers had a lot of pent up demand coming out of COVID. There's only so many vacations we can take, and I don't know about all of you, but I'm getting a little bored of going to restaurants. Like we came out of this, and all everybody wanted to do was eat out. I'm ready to start barbecuing again. So we'll slow, but there's nothing heading into the election to suggest that this is a weak economy. I think people may suggest it in the polls because the high cost of living. Right now, that's a challenge that American consumers have had to grapple with. But to say that the economy is not growing at a reasonable clip is inaccurate.
So did that? I know again, things that people hear and are in the news. So the recent revision of, I think they missed by 1 million jobs.
Rounding error.
That's a fairly large miss. I mean, does that weigh in at all? I mean, does that change your mind at all, or is that it's again, they're political talking points, but we want to know the difference between a true political talking point and a real economic, issue or non-issue.
I always take non-farm payrolls with a grain of salt. It's always a little bit frustrating to me, particularly some of the weeks earlier this year and months earlier this year, where you would get a blowout non-farm payroll report, meaning how many jobs were created in the month, and that would cause interest rates to go up and the market to sell off that day. And we always know these numbers are going to be revised, and a lot of these numbers are estimated. There's other ways to look at it. You can look at ADP's numbers. They actually hand out the paychecks. Now, they don't hand out the paychecks to everyone, but they put out a report. So maybe that's a little bit cleaner. I would say pick a metric, pick an index and stick with it. Don't change. But no, I mean, this is an economy that has still created an awful lot of jobs since the COVID environment. We have seen the number of job openings come down pretty significantly. Most Americans who want a job can have a job. So no, the fact that we revised, again, revision should be expected. And, given what you see from the U.S. consumer and the resilience so far, it's indicative of a labor market that's been quite strong.
Brian, if the job polls or the job numbers are truly estimates and we expect them to be revised, why do you think it is that they're typically revised downward? If it was random, wouldn't we have some revisions up? But I feel like, and maybe my memory is short, but I feel like all the revisions are downward, and so I don't know if that's a political play or not. But do you feel the same thing, or is your memory better where you remember there's been a lot of revisions up?
Yeah, there's probably been some revisions up. I don't know if I've thought about that all that much. There's probably been some revisions up. This is not about the U.S. government trying to help one side or the other. There are not people, in my opinion, working at the Bureau of Labor Statistics or the Bureau of Economic Analysis that are trying to skew this one way or another. They have a formula. They're doing a birth-death estimate, which is basically how many businesses do we think were formed versus how many businesses went out over this time period, and they try to estimate the number of jobs, among other things. So whether that skews to downward revisions, I'm not exactly sure, but I really want to be clear with people. There is not anything more backroom going on here. There's not a deep state thing going on here. People are happy when their president is in power and the jobs are going up. They don't want to believe it when their president's not in power and the jobs are going up.
Take them with a grain of salt. Are there certain indicators that you like to stare at most when it comes to the strength or weakness of the economy?
Yeah, I mean the first thing you want to do is take a look at where are you in the cycle. And so you want to know if the business cycle has room or if you think it's coming to an end. Typically what you look at, if you focus on leverage or excess in the economy. So leverage would be things like business borrowing, consumer borrowing, bank balance sheets. Currently that's all fairly healthy. Excess would be like businesses having too much inventory, the nation having too many homes available. None of that's the case. Rather, what we've had this time, and what you usually then look for after the excess has built, is short-term interest rates going above long-term rates, the so-called inversion of the yield curve, which historically is a harbinger of bad things. Now, in this instance, rates went up because of inflation, but that inflation really happened because we just didn't have enough stuff in this country following COVID. So yeah, we do have an inversion of the yield curve, which could be disconcerting, although most Americans have not really felt the impact of higher rates because most of us have fixed rate mortgages. From there, usually when the yield curve inverts, you start to see signs of survey data really collapsing, whether that's manufacturing survey data, consumer sentiment. For the most part, that's not the case. I mean, things are pointing to slowing growth, but certainly not recessionary levels. And a critical one to look at is corporate borrowing costs compared to risk-free rates. We call that the credit spread. So if you're a business, what do you borrow at compared to short rates? Usually that goes up significantly ahead of a recession. It's the so-called canary in the coal mine. It gives you the warning. That's not a problem that's not a problem at all right now. And if there's any animal lovers on the pod, let me just make it clear that we no longer use canaries in coal mines. We have electric devices now that can detect toxic gases. But anyway, our preferred canary in the coal mine is not squawking right now.
That's great.
I don't